Good morning, everyone. On behalf of Spark Capital, I welcome you to 2Q FY19 earnings conference call of South Indian Bank. We have with us today the management team of South Indian Bank, represented by Mr. V.G. Matthew, Managing Director and CEO, Mr. K. Thomas Joseph, Executive Vice President Operations, Mr. G. Sivakumar, Executive Vice President Credit, Mr. K.N. Raghunathan, Executive Vice President Treasury, and Mrs. Chitra, who is the Chief Financial Officer. Now, I would like to hand over the call to Mr. Matthew for his opening remarks. Now request Mr. Matthew to take us through the highlights for the quarter gone by, after which we will open the floor for questions. Over to you, sir.
Thank you. A very good morning to all, and thank you for joining us for our Q2 FY19 earnings conference call. Let us discuss key highlights of operational and financial performance. As on 30th September 2018, total business for the bank stands at 1,32,324 crore rupees, an increase of around 13.2% YOY. Advances grew by 15% YOY to 57,413 crores, with growth drivers continuing to be retail, agriculture, and MSME loans. Retail grew by 33.5%, MSME grew by 7.2%, and agriculture by 9.8% on YOY basis. The corporate advances, that is 25 crores and above, stands at 20,149 crore rupees. Retail advances, including agriculture, MSME, stands at rupees 37,264 crore as on 30th September 2018. As for deposits, the increase was 11.6% YOY, and the current figure stands at 74,911 crores. The CASA of the bank increased to 18,388 crores, registering a growth of 11.6%. Savings bank deposits grew by 13.5% from 13,526.
Excuse me, sir, this is the operator. Sir, you may please proceed. We couldn't hear you for a minute. Members of the management, you may please continue.
Okay. Current account deposits grew from rupees 2,959 crores to 3,031 crore. CASA now stands at 24.55% of total deposits. NRI deposits have increased by 14% from 17,850 crore to 20,425 crores on YOY basis. NRI deposits account for 27.3% of total deposits. Bank's net profit for the quarter was reported at 70 crores rupees as against 4.32 crore for Q2 FY18. Pre-provisioning operating profit stood at 310 crores for the quarter. Other income was 158 crores for this quarter as compared to 280 crores in Q2 FY18. The reduction in the other income was mainly on account of lower trading profit from treasury book and lower demand for PSLC certificate sales. Our efforts on technology and transaction fees are moving in the right direction, and we remain positive on the momentum. Net interest income stood at 506 crore for the quarter, up from 503 crores for the corresponding quarter of last year, witnessing a growth of 1%. NIM for Q2 of this year is 2.61%. The cost-to-income ratio stood at 55.58% for this quarter. Higher cost-to-income ratio was on account of decline in other income, as explained earlier. In the current quarter, our investment book stood at 18,607 crores of rupees, of which STM contributed 14,859 crores and AFS 3,748 crores. NPAs of the bank stood at 4.61% vis-a-vis 4.54% for Q1 of FY19, and net NPA stood at 3.16% vis-a-vis 3.27% for Q1 of FY19. Provision coverage ratio stood at 41.86%. Our capital adequacy stands at 12.11% for the quarter. The core CRAR is 9.98%. As on date, the total employee count stands at 7,718. During the quarter, bank has opened 9 ATMs and 2 branches. We now have 857 branches, 55 extension counters, and 1,395 ATMs. During the quarter, we have won runner-up award for Best MSME Bank instituted by Chamber of Indian Micro, Small and Medium Enterprises, and CSR award for Bank and NBFCs instituted by Kerala Management Association for the contribution to higher education sector through our flagship program SIB Scholar. With this, we open the floor for questions, if any.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We will take the first question from the line of Prakhar Agarwal from Edelweiss Securities. Please go ahead.
Yeah, hi sir. Couple of questions from my side. First, sir, of your overall book of around 23,000 crores in Kerala, what is the breakup between retail and SME? And what is the impact of Kerala flood that we have seen this quarter?
Yeah, the Kerala advances are 23,368 crores. Now, this needs to be seen as a split between the business which are, not affected in any manner by flood, such as, gold loan against deposit, staff loans, corporate exposures, etc. That is coming to 10,030 crores, a precise number. And the remaining advances in the flood-affected 12 regions of 12 districts of the state are 17,194 crores. Now, out of the 17,194 crores is the advances in the 12 flood-affected districts, of which 10,000 crores is cannot be affected by flood in any manner. So that leaves a balance of around 7,000 crores. Now, that balance has to be split into 2 components. So, the more important thing is we have around 10% of the branches which are directly affected by the flood, really. I mean, in terms of, the constituents getting affected by the flood, around 10%. So, of the 7,000 crores, so 700 crores is the number that can be broadly considered to be affected by flood. Now, that needs to be seen as 2 components. One is the agriculture and rural businesses, which are eligible for dispensation, that is around 500 crores. And remaining 200 crores are about loans in other areas, which don't carry any dispensation, such as mobile loan, etc. So that doesn't carry any dispensation. So we are talking about 2 numbers, 500 crores and 200 crores. 500 crores is covered under dispensation. As of now, some requests have come for availment of dispensation. That process is still on only. So we, from the trend, from the regional heads view as well as the branch views, we get a perception that around 50% of this 500 crore, that is around 250 crores will come for restructuring. Remaining 250 crores will remain completely unaffected. 250 crores will come for restructuring. And because of the restructuring, again, this part will never slip into NPA. On the 200 crores, again by the same logic, around say 50% will face a problem. That is our reading of the situation. So that is around 100 crores. So that 100 crores, as a worst case scenario, we are assuming as likely to become NPA over the next 2 quarters. So we have given a guidance of around 200 crores retail NPAs going forward. That is this quarter as well as next quarter. Instead of that 200 crores as a worst case scenario, we will put it as 250 crores for Q3 and save 250 crores for Q4 also. We try to validate the same data on a different basis, on the basis of the SMA2. So when you look at the SMA2 data, what I was talking about as the 5,000 crores on the agriculture and other sides, and around 2,000 crores which is coming into the mobile loan and other retail loans which are not eligible for any dispensation. Again, our SMA2 is around 4%. So even if you assume 5% as the SMA2, that is also coming as around 100 crores. And that 100 crores, in the worst case scenario, assuming that all the SMA2 will slip into NPA, then also the same number is coming, that is 100 crores, which is what. So by 2 different methodologies, we have tried to validate. One is taking data from the field. One is on the basis of the SMA2 database available with us. And on that basis, both of them more or less correspond to each other, and therefore we are assuming that the worst case scenario, we will have 50 crores addition to NPA on account of flood in Kerala during Q3 and during Q4.
Any provision that we have made on the amount that we think that there will be some dispensation allowed, or we probably will make over a period of time on that as well?
No, we will see at that time, because I know anyway it is a relatively small number that we are talking about. Even now, the dispensation request, we are telling our branches to proactively tell our customers to go for the dispensation where they expect a cash flow problem. But I think many of them are waiting for, the festive season, and overall, the cash flow situation possibly is not as bad as what we have thought about, and therefore we don't find a flood of proposals coming from them. So that is the reason why, we have, arrived at this conclusion, and we are just waiting for, more feedback from the field. So as we go along, anyway, the number is not going to be anything serious in terms of, even the restructuring part.
So on this OPEX front also, because of this Kerala flood, do we see some rise in OPEX also? That because 10% of the branch were directly affected, as you rightly said. So there any increase in that OPEX number that we foresee, or probably not?
No, 10% of the branches affected means the customers of the branches were affected. Like the branches in the rural areas of Kerala are only 10% for us. And basically the branches were all open and functioning, barring some 17 branches totally.
18 branches affected. 18 branches affected. Of which 3 branches were seriously affected. Otherwise, total 18 branches were affected. So if you are asking about the kind of expense that we need to spend for reviving these branches back, it's practically nil. One, because there is an insurance coverage for almost all expense that will come on the capital expense side. And the operational expense may not be much, because only in 4 branches we had to spend some money for real repairs, etc. Otherwise, everything was almost normal. ATMs, of course, there was some issue, but then the ATMs are all covered under insurance, and therefore we don't expect any major expense coming into that.
And so what will be the business impact because of this in terms of growth? How do we foresee that panning out?
We actually, the Kerala business has grown a little faster than rest of India. But we are assuming, like, see, it's a difficult, difficult prediction to make, because we also have the compensating events of the festive season coming up and things like that. So, and again, the second half of the year is generally much better in terms of advances. So therefore, we don't really anticipate any serious slowdown in business. In fact, we are looking forward to a 20% kind of growth, in Q3 as well as Q4 on a YOY basis.
Okay. And sir, in terms of your ILFS exposure, do we have some exposure towards that, and what sort of provisions, if at all, we have made towards that?
I have some constraint in talking about individual customers. We have declared in our filings with the exchange that we have exposure to an infrastructure conglomerate, and we have made a prudential provision. We are confident of the work that is going on around the improvement in governance as well as improvement in liquidity over there. But we have made a prudential provision of 20 crores.
Sure, sir. Thank you so much for all this.
Thank you. Before we take the next question, I would like to remind participants, please limit your question to 2 per participant. You may come back in the question queue if you have a follow-up. Thank you. We will take the next question from the line of Jai Mudra from B&K Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, just on this flood-related issue, you explained 500 crores is the exposure which is flood-affected, of which 250 crores is going to be restructured. So, sir, what happens to the balance 50%? I mean, they would be nearing their scheduled repayment. So, how should one think about that? The portion which will not be restructured?
No, entire 500 crores is eligible for restructuring. Absolutely no problem. But we don't expect those people to come. Even this 250 may not come. So today, if you look at the proposal flow at the branches and in the regions which are affected by flood, it is very, very limited. So the many of the wealthier, farmers and people who are having other income other than the particular crop that has failed may not come to us for any restructuring. They may not want anything at all. So the worst case scenario, we are assuming around 250 crores over there in terms of restructuring.
Sure. And how much duration is the window? So, I mean, this scheme of restructuring is applicable till when? Because this quarter there is no rise in the restructured book.
Yeah, that is true. Nothing has happened in this particular quarter as far as this is concerned, because we are trying to finish it off by October 31st. We are trying to tell it's a very simple restructuring. If people want it, our templates are ready, our centralized processing center is ready. All what we need is to fill up a simple one-page format and put it into the BPM. That's all. It can be done immediately. Because the parameters are all given by the SLBC and everything is very clearly laid down. But then the requests are not sort of, pouring in kind of thing at the moment.
Yeah, because of the other banks, which declared the results yesterday, they have already classified some of the Kerala-related exposure as restructured. So I thought maybe the scheme is up and running and, banks would have classified or people would have availed the restructuring facility if applicable. So for our bank, it would be finalized by October 31st, right?
If at all it is there, yeah. In any case, the number that we are talking about is this. There is no flood of requests coming to us at the moment. As I mentioned, we got just about 10% branches in the rural areas in Kerala. Otherwise, even the flood-affected branches, as Thomas was trying to explain some time back, there were just about 18 branches, of which only 3 closed down.
Sure. And sir, secondly on this infrastructure conglomerate, sir, if you can, sort of provide more color to the exposure that we have, because the entity has a lot of other businesses like power, transportation, and the holding company. So if you can classify, where is our exposure primarily? Is it to SPV or holding company or the transportation entity? That would be much useful.
We, as a policy, we have been avoiding all road, power, SPVs continuously for the last 4 years. So same policy applies everywhere here also.
Then where would be the exposure? If it is not in power and road and also not in conglomerate, then logically we should not have any exposure altogether.
We did not say we have no exposure in the conglomerate. We said in the power and energy SPVs we have no exposure.
Sure, sir, that's helpful. And just last question, sir, if I may ask, sir, now we have provided more disclosure in terms of the loan book below 100 crores and above 100 crores, and that data is useful. just on this external rating, if we were to see loan book above 100 crores, there is still a 9% kind of a exposure which is below investment grade. So would you be keeping this as a stress or watch list kind of a thing? Because you mentioned that, that the slippages guidance as far as retail and SME is concerned is more or less similar, 200, 250. But you did not mention about, how should we see this 9% of, 12,000 odd crores book?
It was around 4 to 5%, if I remember correctly, last quarter. The modification is because of exposure to a particular conglomerate which is into infra, etc. We do not, at this point of time, we do not have any specific information by which we would like to give a very specific guidance on that. And as far as the watch list is concerned, we have just one EPC contractor left in our book from our legacy book, and that has shown some developments of bank guarantees, etc., and therefore we have shown that exposure as already watch list, because that is the beginning of problems sometimes in the infrastructure in that EPC space. So we have already shown it as a watch list item, and we have also made a provision of 10 crores in that. Yeah.
Sure, sir. That's helpful. I'll come back in the queue.
Thank you. Next question is from the line of Renish Boa from ICICI Securities. Please go ahead.
Hi, sir. Good morning. Thanks for taking my question. Sir, my question is on our margin. So, despite, having significantly lower slippages in the quarter, our margins still remain at 2.6, so there is no significant interest reversal which might have impacted at the revenue side this quarter, but still our margin remains low. Even on the spread, we are working on very thin spread of 2.3, 2.4 kind of a spread. Despite our retail book is growing, significantly faster than the corporate book. So what explains this? Are we, chasing growth at the cost of margin, or is it the overall competition which is, taking a hit on the asset yield?
There are two components to it. On the liability side, our CASA ratio is an issue in the sense like we wanted 30%. We are working towards that. 50% of the regions, that is 10 regions out of the 20 regions have already got 30% and above. The remaining 10 regions are still a laggard for us. So we're working very hard with them. So we need to reach that 30%. That is very important. That is one side of it. Second side, the orientation towards security, particularly in Kerala and South India. We were able to ask for getting additional security by way of collateral. I'm not talking about the primary security. I'm talking about additional collateral security by way of residential mortgages, etc. And in an environment in which, our NPAs are 4.61% and we are looking at, containing it very, very quickly by recovering and also moving ahead with significant improvement in the collection. So in that context, it is important not to change that approach immediately. That is the only thing. So not that we cannot do unsecured loans, not that we cannot do other things. We don't have the setup for that. We have the setup for everything today. All the centralized setup is available, all monitoring capabilities available, but then we thought we can wait for a while more before we, reduce our security orientation where it is available. We are not saying that, we will do the same thing in, say, Delhi or Gujarat. We don't. But at the same time, where there is an availability, let us do that for the time being until the position gets corrected, which of course is not a very long distance from now. So that is what we are looking at. And as you said, of course, the NPA reversals, etc. were not there because the large restructured portfolio is not there at all practically. So therefore, that's not there much.
Yeah. So, again, so, sir, is it, what I can understand is because we are focusing on the secured advances, that's why our asset yields are lower. That is by choice. That is what you meant, sir?
Yeah, in the sense like, when we take collateral security by way of residential mortgages, etc., they ask for a very fine pricing. So at the moment it is happening. Then one more difficulty is everything is MCLR linked. So MCLR linked pricing has a problem because all of them are 1 year MCLR typically. And therefore, even if we have done a reset at the beginning of the year, the effect will come only at the end of the next year.
Right.
This is the problem. So while on the liability side it is quick and immediate. So this, of course, I mean, I have a feeling by Q3 we will see some difference. But of course, I don't want to give a specific guidance on that at the moment. But I think, as I mentioned, like a 6-month period is really required for the MCLR correction to kick in.
Okay.
Plus, we are also increasing the MCLR. We have done that.
Right. Okay. And so, sorry to, sir, ask you again on that infra exposure. So, as per notes to account, we have provided around 20 crore on that account. Right, sir?
Right, absolutely.
So, this is what, 15% or what percentage we have provided?
No, it's a lump sum provision that we have made. Yeah. Okay. In case any emergency happens in any one of the accounts, I mean, that's the only thing. Otherwise, nothing more than that.
So just one more clarification on that exposure. So this exposure is a single exposure, or this is in in bits and pieces to some of the subsidiaries, like let's say.
We have no exposure to any of the SPVs. We have exposure to.
Okay. So it's a lump sum loan which is there in the infra exposure side.
This is I mean relatively like maybe a 3-year kind of loans.
Okay, sir. Thanks a lot, sir.
Thank you. We would take the next question from the line of Sri Shankar from Prabhudas Lilladher. Please go ahead.
Good morning, sir. Nice to have a good set of numbers on the back.
Excuse me, sir. This is the operator. I'm so sorry
to
interrupt. Yes, we can hear you now. Thank you.
Yeah. Sir, a couple of questions. So, our cost-to-income ratio has been pretty high. Where do we see this probably by the end of the year, and what's the target that we have for bringing it less than 50%?
Yeah, the immediate target is to bring it below 50%, and there only one number is required. That is the contribution from the Treasury. Treasury gives us 240 crores in a year, 250 crores in a year roughly. And then in a good year, even priority sector lending certificates used to give us 100 crores. Now this year, we have got just 10 crores in the priority sector lending certificates, and we have not got anything from the Treasury for the last 1 year. So we are just waiting for that turnaround. So, it is a good time. Maybe, now things will start improving. The moment that improves, the cost income ratio comes down below 50.
Okay. Sir, during the course of the query that you mentioned that your SMA data is around, outstanding is around 4% or so. This 4% is on what? Is it the 10,000 crores lending that you have from 5 to 25 crores or above 100 crores? So can you be a bit more specific on it, please?
Yes, we have data on every item, but then overall, if you look at the total SMA2 of the bank, it is 2,368 crores, and the total advances are 57,412. That means around 4.12%. And even segmentally, if you look at it, that 5 crores and above, which is getting reported in the CRILC, that is coming a little less, around 4.01%. That's about all. So essentially, I would say around 4% is the SMA2 level.
Okay. So 4% of the total advances, or
yes. Of the total advances, total SMA, not 5 crores and above, which is reported in CRILC. The entire SMA2 for over the entire advances is around 4%.
Okay. Thank you.
Thank you. We will take the next question from the line of Vinod Jairam from ER Advisors. Please go ahead.
Yeah, hi sir. Morning. Sir, on the growth side, the growth has slowed down a bit, especially when the banking industry is picking up. And if I look at the breakup, it is mainly on the South ex Kerala, which is slower compared to the overall bank. So what is the reason for this, sir?
Yeah, actually, the South ex Kerala has not done very well. But there are proposals. Actually, again, what happens in South ex Kerala is that, there are some NBFCs and certain other companies, we have not permitted certain drawings. Because the pricing did not match, etc. So therefore, that creates a small destabilization there. And again, lot of proposals are now in the pipeline in the various centralized processing centers, and typically the disbursements happen in Q3 and Q4 a lot more.
Okay. And sir, SMA2, you did mention it is close to 2,400 crores as of Q2. What was this number in Q1, sir?
Something similar. I don't remember exactly, but something similar. Around 4% is a good number.
Okay. And the watchlist account which you are mentioning, the EPC, what is the exposure there, and is it part of any of our restructured accounts, or is it outside of that list, sir?
Restructure is only just one account. This is sugar. Sugar account has become NPA. So construction EPC, there is only one account which is available in terms of restructured book, and this one is an addition. And this is 104 crore on which we have made a provision of 10 crores.
Okay. And sir, on the fee, you did mention that we have not got the adequate amount of revenues from Treasury and the PSLC. But if I look at just the transaction, there is the fee also. There hasn't been much growth. So it is the growth is definitely less than expectations, especially after the tie-ups with banks, etc., for distribution. So what are the measures being taken there, and if you could just explain why the growth is subdued?
Yeah, the distribution insurance companies, we have a fairly ambitious target. Now, what we have got so far is not very high, but of course, in terms of percentages, of course, there is a very high growth. But that doesn't mean much because we are talking about a relatively small base. So the income continues to be, when it comes to other income, it continues to be driven by, that is the technology part, that is what you call the ATM fees and things like that. And also whatever income we are getting from various internet banking, mobile banking, and all those things. So the distribution has not yet started giving a lot of money, while a number of tie-ups have been made, personnel has been placed by the insurers, and that integration work is going on quite well. But at the same time, the results will take a little while longer is the perception, but during this year, remaining part of this year, we expect a certain amount of improvement.
Yeah, normally the distribution income comes more in the second half. First half is normally it's a little subdued. We have made a lot of tie-up arrangements during the last financial year, which has not fully, we were not able to capitalize fully in the first year. So the full impact of that will come in the second half of the current fiscal. So we are looking forward to a substantial change in the numbers in the next 6 months' time.
Sure. Okay. And lastly, sir, our CET1 is close to around 10% right now. So what are the plans there? Would it be a constraint for the kind of growth which we are looking at for the current year and the next?
Yeah, but of course, at the moment, the immediate approval that we have received from the board yesterday is about raising Tier 2 of 500 crores. And which is permissible, available, and it will, definitely see through the current year. But then we will, of course, be looking at opportunities separately beyond that also.
Okay, sure. Thanks, sir.
Welcome.
Thank you. Before we take the next question, I would like to remind all participants again, please limit your question to 2 per participant, as we have people waiting for their turn. Thank you. Next question is from the line of Sangam Iyer from Shubhkam Venture. Please go ahead.
Yeah, good morning, Matthew, sir. Congratulations on a good set of numbers after a long time. Your patience is paying off. So I just want to understand, on the growth outlook, sir, when you say that the second half we are looking at around 18 to 20% plus kind of a growth, the ask rate is very, very steep. In terms of the incremental quarterly growth coming in, so almost like 3,000-4,000 crores. Can you help us around in terms of wherein we are seeing this kind of quantum jump coming through?
No, typically what happens is in Q3 and Q4 whatever work is done in terms of marketing, in terms of the proposals which have been tied up, all those things, some of them have already been sanctioned, but, there are various pre-disbursement conditions, particularly when it comes to mortgages. There we would have taken land or building and all those things as collateral security, then a lot of search and clearances, legal clearances, all those things are required. So all those things, if you look at the sanctions that we are having and also the proposals in pipeline, we believe that, the MSME also can pick up. So that's all what is required. In the mid-corporate space, there are definitely opportunities. There are, requirements coming from mid-corporate and slightly larger corporates also today. Therefore, we are pretty much confident on the corporate side of the book growing correctly. Then MSME is the one where, we have not done well so far, that this particular quarter particularly. That 7% growth is certainly not what we are looking at. So that is where proposals are there at the moment. So we believe that, that will correct the situation. As far as the pure retail is concerned, it is growing at 30-33% without any problem. And that will continue to do that.
Right, sir. But, when we say that 18% growth for the year, we are talking about almost adding almost 9,000 crores in the second half.
Right.
Which is quite steep given, where we are coming from. So, given the situation normalizing in Kerala, etc., do we see that there is a pent-up that would also be visible in this, 8,000-9,000 crores of jump that we are talking about, which would drive us towards that 65,000 crores?
Kerala also there are opportunities. Outside Kerala there are opportunities. Even, South ex Kerala there are proposals now currently running. We are getting proposals from many clients who were with us earlier, and some of them are coming back. So obviously, there are opportunities coming up. So definitely we are looking at least, say, an 18% kind of growth. In any case, that was achieved last year. So we are very certain about it.
Okay. Sir, so, since you give a color in terms of, for the 18% growth, it will be predominantly corporates, mid to large, who would be contributing in the second half. So the NIMs of 2.6 that we have currently, they would be coming under pressure given that incrementally the larger ticket sizes would be coming at a much lower rate as compared to the retail which was contributing so far in the first half.
Actually, that is not the case, because the retail also, the home loans, etc., are certainly not contributing significantly to the NIM. But the mid-corporate and also particularly mid-corporate business outside Kerala, that gives a slightly better NIM. We may not be having 100% collateral security in that area, but the NIM will improve. They are NIM contributing numbers actually.
So, is there any target that you can share with us in terms of as an exit run rate that one can look at given the kind of mix that we are looking to achieve over the next 6 months?
Yeah, but see, the point is we believe that, even the MCLR improvement should give us something like, 15 to 20 basis points improvement. But then I don't want to give it as a guidance at this point, but let us see what's happening in Q3 and Q4.
Okay. Sir, regarding the slippages, you did mention that, you are looking at around 250 crores of slippage each quarter. That's at the gross level, right?
Correct. Only at the gross level, because what we are looking at is a significant amount of recoveries. Because unlike earlier, we have now got a certain base of retail or at least non-corporate kind of NPAs where active recovery work is going on today. Earlier, we were compelled to sell out a whole lot of it. And the larger ones, obviously, which are going into IBC, etc., we have no hope. But we have another significant base of good quality NPAs with good quality security, and therefore our recovery efforts are going on very well on that. And it will be, and our expectation is that it should be better than this quarter, because we have a guidance of 500 crores and we will achieve that definitely.
Because what we had...
Mr. Iyer, I'm so sorry to interrupt.
This is the last question.
All right, please go ahead.
Yes.
So from a, recovery perspective, we were looking at, retail contributing to 60-70, but predominantly when we are talking about a large recovery coming in, where could you just elaborate a little bit more in terms of from where it will be coming through, which will restrict our incremental, absolute increase in the gross NPA from here on, given that 500 crores is slipping?
For Q3 and Q4, see what we said is we would recover at least 500 crores during this year. And we have done just about 30-40 crores in Q1. And right now we have done about 119 crores. So the remaining part of it, more than 300 crores, we have a very sure plan of recovery in Q3 and Q4. And these recoveries substantially will happen from the mid-corporate kind of accounts and also the retail. Very, very small accounts are also there, quite a lot. With that, this particular recovery can definitely happen. Additionally, if some of the accounts which are under IBC, if they get resolved, we will also get some number. But that is not the number that we are looking at. We are looking at the normal recovery that is coming in from our NPA base, which is already there today.
Okay. And finally, the credit cost number that you can share with us?
We were looking at 150 crores per quarter, and it is around that number as of today. What I can't put an exact number on is about the resolution that would happen in some of the IBC accounts. We have some IBC accounts still in our books, and I do carry 50% provision on that. But then the issue is, when it is going to be resolved? Is it going to be resolved in the next quarter or the quarter after that or after that? And then what is the exact resolution value? How much more I'll have to make, 20%, 30%? I really do not have a complete fix on that. That's my problem today. So otherwise, more or less I think this 150, that means something like 1% credit cost, that should remain.
Okay.
Thank you.
Thank you, sir. I'll come back.
We will take the next question from the line of Chandra Govind from Ashmore. Please go ahead.
Hi, sir. This is Ashwini Agarwal. One question I had. If I look at your slide 22, which talks about the movement in the credit rating of your various loans, and I link it up to your earlier comment, the increase in the sub-BBB categories only on account of this particular large infrastructure conglomerate, or is there something more to it?
Yeah, the account which this particular conglomerate plus one account which we have shown in the watch list. That also has contributed.
That also is included. Okay. That's what I wanted to. And sir, the other thing was that if I heard you right, you had mentioned that your additional slippage per quarter over the next 2 quarters is going to be 250 crores or so, but that would be from the SMA and the retail category. So would slippage from corporate be over and above that, or is this your aggregate slippage guidance?
No, see, today, in fact, when we were talking about this 200 crores and also 250 crores, we were really not counting any corporate slippages. Because, I'm not talking about small corporate. From 25 crores to, say, 25, 30, 35 crores, if something slips also, it doesn't matter to us so much. It will all be accommodated within this. If anything happens of that variety, nothing is very clearly visible at the moment. But we have certainly not counted what we call the large corporate part. That is, even this 100 crore, 104 crore which I have shown in the watch list is not shown over there. It's not counted in this.
Okay. So when we spoke at the end of the first quarter and when you said that for the rest of the year expect 600 crore of slippage, that was X the large corporates.
Yeah, because large corporate, in any case, we thought we had come to the end of the cycle. We didn't have any further problems. Even this particular company which we have now shown under the watch list was at least AA or at least A rated definitely. So, that is the reason why we were really not looking at any slippage. And otherwise, if you look at it, we don't have any aviation, we don't have any telecom, we don't have anything like steel at the moment. So we have completely stayed away from all these things. There are no EPC contractors which we have added. We have some road projects which are sometimes SMA2, but then what we thought would slip has already slipped. So therefore, we are assuming that, the portfolio, that's 100 crores and above portfolio, which gave us a very difficult time over the last 3 years, has come to an end. That problem, the problem from that side has come to an end.
But sir, that is still 9.3% of a 12,700 crore book, right? So that still gives you roughly 1,000 crore pool, which is in some way stressed, looking just at an external credit rating parameter.
Yeah, that is right in that sense. But, our experience so far is that, they have been more or less holding, barring, of course, recent development. But otherwise, all other cases, we never had any problem as such. So it was reasonable to assume, and even now it is reasonable to assume that, that book can hold, barring the watchlist account which you are talking about.
Okay. Thank you, sir.
Welcome.
Thank you. We will take the next question from the line of Dhaval Gada from TST Mutual Fund. Please go ahead.
Yeah, hi sir. Just a couple of clarification. One, on the conglomerate exposure, if it were to become an NPA in the next quarter, would we be required to make additional provision? And the second question is on slide 12, you give your average ticket size per account on SME, which is about 30 lakhs. I just wanted to know whether it is incremental or on the overall portfolio at this point of time. Thanks.
Yeah, the first part, of course, we are assuming that the work that's going on around that is pretty much strong, and there may not be any problem. That is the perception we had even in the board meeting yesterday. Of course, if it slips, of course, what we have made is only a prudential provision. I can't say that we won't require any further provision. As far as the other slide is concerned, the average ticket size is the current average. Yeah.
Sorry, sir, I missed the answer. You're saying it's the average of the loan book.
I said average ticket size of the MSME book.
Yeah, but on incremental disbursements made or on the entire portfolio?
Or on the entire book. It's on entire book.
Okay, so then in that case, I have a follow-up. If I divide that number by your SME book over the last maybe 10, 12 quarters, the live account number comes down to about 44,000 versus maybe 65,000 in 2Q FY17. So has the number of live SME accounts coming down? Is that a trend that you're seeing in your portfolio?
I don't know about the reclassification issues in that. We will come back to that separately. Our DGM IR will come back to you specifically on that.
Okay, fine, sir. Thank you so much.
Thank you. We will take the next question from the line of Sai Kiran Pulavati from RW Investment Advisors. Please go ahead.
Hi, sir. Two questions. I think in the last 3-4 years, we have done substantial investments in the retail. We can see the growth again, but if you can just elaborate what kind of profitability, especially on the always side on the retail book, is going on at this point of time. How do you see this panning out for the next 2-3 years? That will be really helpful. And the second question on the gold loans. What we have seen is certain gold finance companies are growing at a faster pace, and we having inherent strength in that segment. Do you foresee a scenario that the gold loan book can grow faster, that too when the gold prices are moving up? And the final question, the third question is on the corporate. In one of your earlier comments, you mentioned that we are at the fag end of the corporate credit cycle. And I believe based on your own experience, do you foresee a scenario where you would like to grow the corporate loan book, that too when the risk-reward ratios are favorable? Thank you very much.
Yeah. I will start with the gold loan first. Gold, as what you said, is absolutely right. definitely this is what is currently going on is not the growth rate that we want. We are very, very serious about it. Around 150 branches of the bank are most ideally placed for this, and they were doing a lot of gold loan, and only at some particular point of time, because of some isolated problem with some replaced gold, there was a kind of exit from that portfolio. So we are definitely trying to rebuild that, and I think there is an opportune time that is coming up. We are hoping that we will be able to improve that performance. As far as the large corporate book, the mid plus the corporate book is concerned, yes, we are definitely looking at opportunities. And as long as, see, for example, a lot of, large corporate book, we had to sort of, make NPA and also sell out. So that portfolio has come down significantly. Definitely, for the bank's size and capability, it can definitely grow a little bit more. Only thing is, our principles continue to be the same, that is, we stay away from stressed sectors. We are willing to take fairly large exposures with certain groups which have never defaulted in their history, and also in highly rated accounts. So we will look for that. Of course, our risk appetite will be a little lower, obviously. So that will be very well calibrated. And then when it comes to the retail growth, the growth is coming up quite well. And we are happy about what is going on in the mortgage space, in the auto loan space, and various other business loans, etc., up to 2 crores. Only thing is, we need to do a lot more work on, many other ancillary opportunities. Like, for example, some of the unsecured loans also we can look at with the kind of capability that we have built up in the retail side. Therefore, the profitability also can improve going forward. That is the plan. But then the whole exercise is done in a very careful and calibrated manner, keeping the risk element in mind all the time.
So if you can explain what is the current level of profitability in the retail, it is below the overall ROA levels, or I would like to understand whether it is sub 1% ROA because it is subscale and it is expected to improve forward. That will be really helpful.
I don't carry at the moment the data, but my sense is definitely it is almost equally distributed, because even I'm talking about the pure retail, that is the mortgages, etc. But it is also, in the case of mortgages and auto loans, maybe the pricing is a little, less. But at the same time, that there are business loans where the pricing is a little superior. Therefore, net, the retail portfolio will give a profitability which is something similar to the MSME and also the mid-corporate. It may not be very different. But of course, we will validate correctly and then come back on that.
Great. One final data keeping question. I think the employee expenses has been seen a very steep hike in terms of the growth rates on a year-on-year basis. Can you explain what's the reason behind it?
Sure. There was some gratuity revision that has happened during the current year, that has happened during the 6 months' time. Plus, there was the IBA, as per the, we are an IBA bank, and therefore the salary revision which is expected to come shortly. So we had also already started providing for that from last November. So that also has predominantly come through this 12 months' time. That's the basic reason why there's a growth in the staff expenses.
So there is no one-off at this run rate. I think you expect this run rate to continue.
The one-off is over, actually. The gratuity part is already over. We have already fully provided for the gratuity increase that is mandated. And as far as the salary increase is concerned, we are paying 12%. 12% we are putting as a provision, yes. And we don't expect salary revision to be anything more than that number under any circumstances.
Thank you. That's it from my side. Thank you very much.
Thank you. We take the next question from the line of Nilanjan Karfa from Jefferies. Please go ahead.
Hi, sir. Thanks for quite a detailed presentation. Had a similar kind of question to an earlier on the SME ticket sizes and reconciling that with the SME growth. I think if you can put up reconcile the data whether we are talking of the same series or not, because then there will be inconsistency between the various numbers we have put out on the loan book as well as the ticket sizes. That will be useful. And secondly, in that same vein, if we look at the breakup of the loan book, for example, right, more than 100 crores is like 12,700. And if we classify the corporate book as 20,000 odd plus, which basically implies, greater than 25 crores, which is 10.4 plus, 10,400 and 12,700. So there's just about 2,000 odd crore, which is probably getting classified as an SMA in a very high ticket size. And then, if we look at the average ticket sizes, that's only about 31 crores. So again, very hard to predict from outside, but looks like very large, lumpy accounts are sitting in the SMA book. And practically the tail is actually very, very small. So just wanted to get some clarification on that as well. And the related question is if you can talk about how the pricing power has been holding on the SMA book over the last, 4 to 6 odd quarters. Are you facing a lot of problem, doing growth which is also less credit risk prone? Those will be my questions. Thank you.
Yeah, one, of course, the data point we, DGM IR will come back specifically on that. That part we will take care. If you are talking about SMA 2...
no, I'm talking about SME loans, sir, not SMA 2.
I know, but you are talking about that part we'll take care. But did you mention about SMA 2 also?
No questions on SMA 2.
Thank you. Pricing on the SME book. Okay, on the SME book pricing, yes. I mean, the issue is, the Kerala-based and, in fact, Tamil Nadu-based. These are the two geographies in which we really ask for and people are willing to give us collateral security by way of residential mortgage, land, etc. This is a thing that has been continuing for several decades, and we continue to, derive some advantages in terms of security comfort and also maybe protection from NPA, etc. And therefore, when you take all these things, the problem is that, the pricing is very, very fine there. And we have to perhaps continue with that for the time being because, our corporate problems are all substantially recognized. I don't think there is anything much coming up anymore. But the provision cycle has to be there for some more time. That's about all. So, in that sense, we are at a level at which we can start reviewing that policy. So, some of the areas where, where we are insisting on getting, 50 to 100% collateral security or sometimes even more than 100%, where based on the balance sheet and the quality of the promoter and the relationship, we can look at reduced collateral security and improved pricing. That is what we should be doing. And we are very willing to look at that. This is an area which we have been internally discussing for some time, but it takes some more time because I think maybe we will wait for this NPA cycle to really settle completely. That I think we should be seeing in the next 1 year in any case.
Right. So I just want to get a clarity, are you seeing structurally the returns or the ROEs or IRR of the SME portfolio kind of shrink over the last year or so?
Not very specifically, but then, some of the takeover accounts have been maybe slightly on a finer pricing to begin with. Mm-hmm. So that is one. Second problem is that MCLR issue. The MCLR, although we have increased the MCLR, the benefit will kick in only after 6 months at least. So this is where one small problem is coming. So in the last 1 year, you suddenly look at MCLR has been increasing, but no benefit has kicked in. And on the liability side, yes, it is going up immediately. Oh. So this is an issue there. So that is why I said, I may not say very specifically about what would happen in Q3 and Q4, but let us see what happens. We should look at an improvement in Q3 and Q4.
Right. But can I stretch this equation first? Let's say we take the MCLR hike, with the lag effect, whatever MCLR hikes come through. Will it now, increase competition with some of the, the larger pan-India players, therefore, because they would have raised their MCLRs a lot lesser? Or do you foresee that your relationships are so strong that you will not lose those, business?
our customers are, going to other banks, that is not, expected in any manner significantly. But our takeover capability sometimes is also a little dependent on pricing. But then, in the current environment, even with our level of MCLR, which is there today, it is possible to look at takeovers without any problem. It is possible, definitely. We may not be getting too much of a risk premium over the MCLR, but MCLR, I think, is a reasonably priced one at the moment.
Excellent, sir. Thank you for those answers, sir.
Welcome.
Thank you. We would take the next question from the line of Drashti Shah from Investor Capital. Please go ahead.
Good morning, sir. So on slide number 22, you've given SIB internal rating, and your below BBB book is 20.8%, which has been declining since a year now. So what is the historical trend of slippages from this book?
This is the total corporate book. Basically, what's happening is, if you... No, it's 25 crores at above. That's the one. So this 25... Yeah. You're talking about the second part of the slide, internal rating, isn't it?
Yeah, slide number 20.
Yeah.
The second part, SIB internal.
Yeah, this 25 crores and above, that particular number, more or less, the slippages have been really higher on the 100 crores and above historically. But even that has now come down to a very stable portfolio. And as far as the 25 crores and above, except in those cases where, like for example, last 1 year, we had problems with the cashew industry in Kerala. We also had 1 or 2 cases of gold accounts turning bad. These are the, cases where, if you look at the NPA level, it has increased because some of these are fairly sizable exposures compared to the average ticket size. So these are the only things that have created a, major change. Otherwise, the slippages are reasonably good, and it is more in line with what is currently being seen. In the current quarter, whatever slippage ratio that we have shown, that appears to be a fairly moderate, fairly expected kind of trend. Of course, we are trying to improve upon that also by very proactive monitoring. But otherwise, there is no trend which shows that, there will be an accelerated slippage from here in this particular portfolio.
Okay. And, sir, you mentioned that your SME2 book is 2,368 crores. So, and that is not part of the watch list. So, is it that you don't expect that book to slip, or, you have good collateral against that book, or,
So this is actually a distribution from the smallest account to the largest. All of them are involved in this. Now, if you look at the large corporate, that is 100 crores and above, there are only 4 accounts with a total of 488 crores. And that is all visible accounts. One way or the other, we have spoken about those accounts. It is there. Now, the 25 crores and above total also, including the above, is around 8 accounts, which is 732 crores. So what I'm trying to say is the remaining part of these accounts, which are all, zeroed, a few lakhs to 25 crore kind of thing. There is nothing like watch list that we are maintaining. We are carefully watching that, and the slippages that we are talking about, like the 200 crore kind of slippage that we are talking about, emanates is as a result of all these things, barring the large corporate.
Starting by saying SMA2 is out. SMA2 is outside the watch list. It's not fully correct now. It's adding SMA2 plus 1.
Hello?
Yeah, hello. Yeah. No, one clarification is that the one account which has come into the watch list of the large corporate is also part of this SMA2. It is not different.
Okay.
Yeah.
But out of the SMA2, you only expect 200 crores in the watch list, and you expect that to slip. not the entire amount?
No. SMA2 entire amount, we certainly don't expect any slippage out of that. That doesn't come at all.
Okay. And sir, any NIM guidance that you would like to give?
As you mentioned, we are looking at some benefit coming out of the increase in the MCLR over the last 6 months. That is supposed to give us a benefit of around 15 to 20 basis points actually. But then that benefit so far has not kicked in. So that is where, we are just a little cautious and careful about giving a guidance on that. So we said we will wait for Q3 and Q4. But from the increase in the MCLR, we should be able to get around 15 to 20 basis points improvement normally.
And sir, if I can squeeze in one more question. Sir, the CASA growth has been 12% for this quarter, for this year. It's still very low. And so why isn't the CASA growth kicking in, and what are we doing for it to increase?
Yeah, CASA growth is fairly good in about 50% of the regions. About 10 regions of the bank, out of the 20 regions, 10 regions are growing reasonably well, and their CASA ratio is already about 30%. For the remaining 10 regions, we have a problem. It's also about, getting more current accounts using our POS machines and getting more savings bank accounts using our products on various technology products as well as the loan products. And then also, very focused marketing in terms of a CASA group, which is working in the centralized marketing and processing center. So a lot of work is going on around it. But then, I would say that, we have more distance to cover as far as the CASA growth is concerned. I agree that, this particular growth rate of 11.54% is not what we are looking at.
Thank you. Well, ladies and gentlemen, this seems to be the last question for today. I would now like to hand the conference over to Mr. Naveen Babu for his closing comments.
Thank you, Janice. On behalf of Spark Capital, we thank the investor community for dialing into today's call. I would also like to thank specifically the South Indian Bank management team for taking time out of the busy schedule and patiently answering all our questions.